Hello everyone, welcome to another Reuters Events webinar. Today we'll be talking about social factors. This is a highly requested topic, so happy to bring you this webinar today. We will be taking questions primarily towards the end of the session, but if you've got a question, make sure that you write it down and submit it immediately so you don't forget. There's a Q&A box at the bottom of your screen. There's also a chat box. Please don't submit your questions in the chat box, they'll get buried. So submit it into the Q&A box and we'll make sure to try and get to that. So we have Jessica Eistrand today, who's from Hansa Impact Partners, and she will be chairing the webinar. So I'll hand across to Jessica.
Hi. Thank you very much, Dominic. Yes, I'm Jessica Eistrand. I'm a co-founder of Hansa Impact Partners. We are a consulting firm with a mission of promoting ESG and impact investing. We're very happy to be working with Reuters Events on a number of webinars. And today we will be discussing social factors as an investment theme. We've invited three great speakers to join us today to enlighten us and share their expertise and experiences. And over the next hour, we will uncover and learn more about some examples of how investors address a few of the social challenges we're all facing. If we look at the UN global goals, so the 17 of them, it's interesting, the environmental and social matters tends to get a lot more focus. The purpose of this call is to highlight that investors can make top quartile returns while contributing to social impact goals and be the financier for solutions to social problems. We will primarily be talking about growth stage private equity investments, because these are enterprises, are proven businesses in the need of more capital to grow and scale their businesses. And the impact is quite direct. Let me introduce the speakers very briefly. We have Marcus Svedberg, who is a strategist from one of the AP funds in Stockholm, AP4, to discuss the big picture from an allocation point of view. Marcus will share his perspectives on ESG and impact investing from the perspective of a European asset owner, and how these topics get incorporated into the investment process. We then have two growth stage private equity investors from the US, Builders Fund from San Francisco, Trip Baird, and Mark Grovic from New Markets Venture Partners just outside of Washington, DC in Maryland. The Builders Funds takes a thematic investment approach, largely around two themes, health and well-being, and sustainable consumption and production. So I mentioned briefly that we have Marcus Svedberg with us, we have Trip Baird from the Builders Fund, and we have Mark Grovic from New Markets Venture Partners. New Markets Venture Partners invest in in the edtech sector, educational technology. They look for companies aiming to improve educational outcomes, job market access, and facilitating financial inclusion. With that, shall we get started? I'll hand over to you, Marcus, if you give a little bit more detail. Tell us about yourself, about your role and the firm that you work for.
Sure, thanks, Jessica, and well done with all the interruptions. So AP4 is, as you mentioned, it's a Swedish public pension fund. We have roughly 40 billion euros under management across assets, across geographies. Myself, I'm an investment strategist, which means that I do all things macro and a lot of things sustainability related as to our different portfolios. It could be anything. It could be private equity, it could be public equity, it could be bonds, FX, and so on and so forth. And I guess for the fund, sustainability and ESG are very important factors, and across portfolios. We don't have separate buckets or separate strategies. It's supposed to be integrated in all the things we do across asset classes and so on and so forth. And I'm saying supposed because this is very much a work in progress. We're constantly evaluating, we're constantly exploring different themes, different ways of getting access to things we like and getting less exposure to things we don't like. So and again, out of the three, I guess we'll get into this in more detail. But out of the E and the S and the G, the S has always been a very important one, but also perhaps one that has been focused on the least. Not necessarily the one that's been done things with the least, but the focus has been least. So I think this is a timely exercise to dig a little bit deeper into the S, what it is, and our different roles in exploring that, both in terms of negative screenings, but also in terms of positive screenings and positive selection, what we can add to our portfolios. And I'm personally very keen to hear what Mark and Trip how they are viewing this and to take this forward.
Thank you very much. Trip, are you back on? Or Mark, in the meantime, please tell us a little bit about yourself, about new markets and the work that you do.
Sure, thank you, Jessica, and apologize to everybody. Persevere with us like good entrepreneurs. We'll keep coming back on if it keeps getting kicked off. Thanks everyone for joining. I'm Mark Grovic, founded New Markets in 2002. Prior to that, had done private equity with the Calvert Group, which is really the founding visionary firm in socially responsible investing in the U.S. And I worked right for the CEO and saw their work with Ben & Jerry's, Anita Roddick from The Body Shop, Muhammad Yunus at the Grameen Bank. It was very inspirational for me in role that private equity could play in social entrepreneurship back in the early 90s, and dedicated myself to that. Did 10 years of emerging markets with Franklin Templeton as they started a private equity group called Templeton Direct Advisors, and then migrated to and worked in Poland, Eastern Europe when the wall came down, and then in Latin America, and then started New Markets 2002. And we've evolved into a leading education and workforce firm in the US that works with constituents across the public and private sector to create ecosystems that drive economic mobility in a very measurable way for when we say at-risk populations, which most people might. So the idea of addressing, in the United States, I think globally there's folks that have a perception of political and economic stability that's going on. And our view is, we have a shrinking middle class in the United States, and a lot of that is around education and job skill issues where, 50 years ago, if you didn't graduate college, there was still a pathway to a good life, income, raising your family, being able to have a manufacturing job perhaps. So now we have a very high demand for skilled labor, and still in the US, of 100 people who start high school, only 70 graduate college. And so of those, about half get a job at their employment level. So about 15 out of those 30 that graduate college are unemployed or underemployed when they graduate. So the US education market fails about 85% of people. And there's a lot of interesting approaches to addressing that, both in terms of getting them skills and alternative pathways or improving retention in high school and college. So what we do is we focus on very specific interventions with commercial models that improve people persisting in school and or getting them the skills that they need. And then in the past 5 years, really leaning in with the employer to bring the Fortune 1000 into the equation where the education system isn't really stepping up. And folks in Europe understand the role that employers play in getting people the skills that they need. And there's a lot of economic opportunity and commercial opportunity for the US to evolve like that. So we've done a very good job over the last 10 years. We've addressed the needs of 25 million students and adult workers in a very measurable way and have driven top quartile returns across our last 3 funds, not only in IRR and value, but actually in cash on cash distributed. So there's a distributed to paid in capital metric that we really like, people who receive cash back based on invested capital. And we're top quartile across our last 3 funds on that metric, which means not paper gains, but actually cash return. So this idea of 25 million folks getting economic mobility improved in a measurable way, combined with these top quartile returns is what gets us up in the morning. It's very challenging, but we think it's very important, not just for the lives of those 25 million, and not just for the economic and political stability of the US, but actually has global implications. So look forward to drilling down into more specifically what we do and how we do it and what we look for, but let me leave it at that as an introduction.
Thank you, that's fantastic. Trip, do you mind giving a short introduction to yourself also and about the firm and what you do?
Yeah, good morning from California, everyone. Sorry for the technical difficulties. My name is Trip Baird. I'm a co-founder and managing partner of the Builders Fund. Builders is a growth stage private equity fund investing with an impact lens at the intersection of purpose-driven brands and the disruption and therefore opportunity created by the need to solve large social and environmental problems. What that means is generally writing $10 to $20 million checks into businesses with 20 to 100 million of revenues, small cap buyouts, growth equity, with a thesis that really revolves around 4 core factors. Number one, that purpose-driven brands are winning in the marketplace today, driven by a host of different things, ranging from shifting demographics here in North America, the aging of the baby boom population, rise of Gen Y and Gen Z in terms of buying power, and increased transparency created by kind of ubiquitous access to information via the internet. Number two, that the alignment of values through culture at a company with your employees and through an activist brand with your customers or prospective customers can be harnessed to create meaningful competitive advantages in the marketplace. So think winning the talent wars, driving better retention, longer tenured, more skilled employees who care more about their work and are generally more productive and engaged in their work. Also, data shows give better customer service experiences, which is a primary driver of customer loyalty, which drives growth and profitability. And then similarly, externally through a values-driven brand in the marketplace, you drive better net promoter scores, increased probability of word-of-mouth marketing, which lowers your cost of customer acquisition and improves your margins and drives growth. So purpose really through numbers linked through a value chain to growth and profitability. We've set our fund up to try to leverage that value chain with growth stage businesses. Number three for us is really the topic of this webinar, this sort of notion that systems responsibility will increasingly be a source of competitive advantage for companies in the context of rising awareness of large intractable social and environmental problems, with the vision that a higher form of corporation, both from an economic return perspective in the long term, but also from a moral perspective, is one of a long-term value generating platform that creates value across its corporate ecosystem for all stakeholders. And in so doing, generates shared value for those stakeholders and drives economic value as an output. And then the last piece for us is this notion that operationally oriented private equity funds tend to outperform their peers. And so we've set our fund up around this concept by raising half of our capital from former operators and C-level executives who serve as a network and an operating bench of operating partners to help our management team succeed. In terms of themes, you know, the intersection of purpose with large problems for us makes us more of a generalist than Mark, who's very focused, obviously, in terms of his specific challenge. For us, as Jessica outlined, you know, what that means is trying to fix the broken food system, industrialized food system in North America, address the chronic disease crisis in this country, the obesity epidemic. We've got 60% of our population is overweight and 40% is obese, which is breaking the U.S. healthcare system, not to mention really damaging many lives. Climate solutions, the need for more resource efficiency on a finite planet. And then lastly, what we call human elevation, which would encompass social justice, equality, quality job creation, and job training. And for us, this all manifests in a later stage private equity portfolio. Again, not taking technology risk or business model risk, but really investing for growth, partnering with management teams, and then leveraging our experience in taking businesses from you know, really a certain size and stage up to more efficient segments of the capital markets, and generating our returns through growth and then multiple expansion. My background, in brief, about 20 years in private equity and traditional finance roles. I previously co-founded and built a merchant bank focused on these same themes over an 8-year period, which we subsequently sold to Piper Jaffray. Early part of my career was at Bain and Goldman, and then a mid-market buyout firm called North Castle Partners that focused on health.
Fantastic, thank you. So before we go down and dig down further into the S, let's just, you know, talk about ESG and impact or responsible investing, SRI. Marcus, do you want to give us the high level? How do you see it? How does your organization consider those terms, and how do you direct yourselves within those terms?
Yeah, I think it's there are a lot of overlaps, but if I just start from our end, we have we're a public pension fund, so our mandate is written into law, so it's quite convenient. You can just go to the legal text and see what it says, and what it says. It's in Swedish, but it says that we are supposed to be an exemplary asset manager, creating high long-term returns with a special focus on sustainability without compromising the returns, right? So it doesn't say anything about impact. It doesn't say exactly what an example is. It doesn't, say what responsible means and so on. So that's a bit up for interpretation. But ESG is really, and all three letters, right, are really integral parts of all things we do. And I said in the introduction, it's part of all the decisions we take, regardless of underlying assets, regardless of jurisdictions, and so on and so forth. And I think, when I listen to both Mark's and Tripp's introductions, there was a lot of things I could just, thematics, you're really looking for things also that, will outperform in a financial sense, but then also from an impact sense, societal sense. We don't start our analysis with the impact, from the impact side, because that's not part of our mandate. I do think that there are very important overlaps. A lot of the impact investments are perhaps some of the most sustainable investments. Some of the impact investments are not, great financial investments. And as long as you're clear, you're upfront, where you're coming from, and both these sides, I think there are a lot of common denominators. But I think sometimes large asset owners are taken a little bit back by the whole impact space partly because it's small, and we struggle with scale. I think we can get into some of those, but I think there are ways to really scale up and find interesting solutions to do that. And then also to focus on where do we see those overlaps, where impact and the broader sustainability lens go together. And I think there are quite a few. Just top of my head to mention a few that was already mentioned. Plant-based foods, future of proteins, we're going to get it from. I think that's a very, very clear one. Healthcare is obviously also a very clear one. Exactly where in the value chain you want to be, exactly what you're, that may differ from fund to fund, the whole green agenda, obviously. Equality is also another clear one. So I think from the negative screening point of view, we know exactly or almost exactly what to look for. I think we need to do more work and more seminars like this also to distinguish the investment opportunities. And at the end of the day, it's always much more fun and much more productive to focus on the things that you want to have more exposure to rather than the things you want to have less exposure to. I mean, we need to do both, right? But it's a much more fun part of the job to actively look for things that you want to increase exposure to.
Thank you. And Mark, when you started New Markets, there wasn't any ESG term probably in 2003. So when you set up your firm, how did you take on the concept between responsible investing and financial returns? And how do you see it now?
Well, in the early 90s, when I was working at Calvert, what I mentioned that they were really the thought leaders in what they were calling SRI at the time, socially responsible investing. And like Marcus said, they started with these negative screens and then started moving into more intentional investing and solving social problems. I was listening, having done this over the last 30 years, for me, efficacy and commercial viability has merged 100%. And so if something doesn't work, then you're not going to really do well financially. So then this idea of what does it work on or what does it work for? And then, we're very focused on customer value propositions. And so our customers tend to be organizations that are serving people or corporations that are trying to build the skills or hire people. The longevity of skill sets in the corporation are very low these days, right? So people need to be constantly retrained. And although there's a huge unemployment problem in the United States now because of COVID, there's still this huge skills gap where employers can't find the people that they want. So there's unemployed population, there's the employers. It's all about human capital now for employers. 50 years ago, companies were valued based on hard assets. And today it's all about intellectual capital and people. So I'm saying 100% now of companies moving towards dealing with people and improving people's skill sets and performance is the focus of the entire economy going forward, and the ability to provide human capital to those. So for me, I think probably our environmental crisis might be the number one problem, and number two is creating a workforce and economic mobility globally. So I can't think of too much that's not sort of focused on this human capital problem. And I think increasingly the idea of investing in something that's not socially responsible is getting narrower. And why would capital go to places that aren't solving big problems for us as humanity? What is the real point of building a company to put more cookies on your website when there's thousands of companies trying to serve you the ad in a more targeted way, when there's these huge human problems and environmental problems that need to be solved with tremendous commercial opportunity? I think the idea of doing that is going to fall by the wayside over time, and the socially responsible impact world will take up 90% of the market in the next 50 years.
And Trip,
I totally agree with that, Mark. The comments you make really highlight for me a lot of what we do, and I think you do the same, which is this sort of rejection of shareholder primacy as a concept being really central to the next decades of capitalism and company building. So many of the problems that we have faced over the past, or are just coming to a reckoning with today, come from this sort of short-term and extractive behaviors focused on generating returns in a vacuum without concern for externalities. And so what you've just said really resonates with me and with Builders Fund. So much of what we do also is focused on the same concept, which is purpose-driven businesses being built around solving a problem are fundamentally built with product market fit, right? And because these are long-term trend-based issues, the way any investor who was trained as I was in looking for trends and then winners within those categories, it's just the most amplified element of that worldview, right? So totally agree with the comments.
Yeah. Can I jump in there? Let's say, I hope you're right. I'm not yet convinced you're right, but and I really like talking to niche, or not niche players, but advanced market leaders, right, in what they do. I think that's great. I think one challenge, if I may, one challenge for the impact industry, if there is such an industry, but is not to remain a niche industry, right? Become mainstream. And let me just use the whole green agenda for a second. There's been a lot of focus, a lot of things written up on green bonds. They're growing, everyone thinks it's great and so forth. It's roughly 1% of the bond market. I do think green bonds are great, but I'm much more, when I look at our portfolio or anyone's portfolio, I'm much more keen to make sure that the 99% of the rest of the portfolio becomes as sustainably as possible, rather than making sure that 1% becomes 1.2%, 1.3%, right? It's not one or the other. I think we can do both, and we need, again, front runners that are experts there. But I think, an important element, and I hope maybe this webinar, is also helping to address that we also push, the big picture. I don't know exactly how to do it, but I think we need to think harder how to do those things, because it's obviously that's what matters. Another related thought on impact is also to think about the delta. We all like to work with best in class. And again, I'll take the example from green. Of course, it's great to work with the most efficient companies when it comes to CO2, or the ones that are already at neutral. The biggest impact is probably, where the change delta is the biggest, if you take someone who's not that great and make them great. Mark, both you and I worked a lot in emerging markets. There was always a joke in emerging markets that you make most money when you invest in crap and it becomes, decent. I'm not saying we should invest in bad things, but we should, help also companies to become better. We should help, and again, that's where you really can have a big impact delta and a big financial delta, right? Because the financial metrics will respond to that change. You can make money investing in best in class as well, but the performance delta impact delta is probably smaller.
Mark, do you want to address that? And also, if you want to give us some examples of investments in your portfolio.
Sure. I think there's a philosophical grain of optimism I'm not going to get it perfectly right, but Martin Luther King has a quote about the arc of the universe is long and towards justice. And so, you know, over the last 30 years, when Marcus speaks of helping, you know, challenged companies get to decent, you know, in my head is this whole sort of, is there a policy framework that moves in the right direction in general? You know, in the U.S., it's very state by state, and so we see many states having more progressive agendas, and our companies tend to do better in those states. You know, we have to get legislation, and sometimes it's a reform legislation that tends to be seen maybe as conservative. For example, we had the market leading dropout recovery company where we took students that had dropped out in the US. So there's 4 million students that dropped out in the US. States pay approximately $10,000 per student to educate students. And it's a kind of a constitutional benefit. If you're of age, you get this $10,000. And so it's 4.5 million dropouts in the US, or $45 billion market. 4.5 billion market. And so we're going after this market with a market leading firm, giving a high school diploma in partnership with the district and a job credential and a job. And each state needed legislation to allow this sort of blended learning for the district. And we had to go get approved in every state. And there were regulations like count days and seat time waivers and things like that to do a blended learning approach. We had soft skill training, career and technical education training, in-person social workers, online academic coaches, online teachers and tutors. Wildly successful. We just exited. It was a 5 times investment return, couple $100 million exit idea. And so, you know, when you think about that in the context of people moving in the right direction and adopting a policy framework that's going to encourage that. And Marcus, there were some social bonds that were put in place around those as well. And a lot of that's really difficult blocking and tackling, right? There was no magic in the success of that company. It was just excellent execution and hard work and showing efficacy and driving constituents to adopt the policy through proven outcomes. Once we had outcomes in 7 states, we were able to go to 30 pretty quickly.
Can I just Mark, are these basically payment for results, or how does it work?
You know, what's interesting is initially the company wasn't in a financial position to do that. So it really limited our growth. And then once we got to a certain size, a size that Trip gets interested in, then we were able to do more pay for performance and take the risk and pay the upfront. You know, initially it was just a cash flow. We had the efficacy, but we couldn't deliver for the students without the cash to front. You know, sometimes it was a year in arrears we would get paid when we had to show the performance. So eventually we got there. We had to get to scale in order to provide that level of service.
Trip, do you want to give us some examples from your portfolio companies?
Yeah, I'd love to. Maybe before I do, Marcus, I want to say in response to your last comment that I absolutely agree. You know, I think we will have to, over the next 20, 30 years, reinvent every industry on the planet to be more responsible, sustainable, systemically aware of multiple stakeholders, not just shareholders. And so there's opportunity across every industry and every type of business, not just best in class. I do think that in order to move the traditional financial world, traditional business world in the direction of ESG and systemic responsibility, we have to demonstrate that we can generate above market or market rates of return doing what we do. And so I think the best way to do that is ultimately the types of things that Mark and I are doing, investing in best in class, mission-driven businesses that are focused on generating real outcomes. And I think the evidence is starting to really fast as we've started to have a decade or two of evidence to show for it.
Can I just make a maybe provocative comment before you go to your example? And I think you mentioned a couple times not having shareholders be the primary constituent, but we have a lot of institutional investors and family offices who want sort of long-term returns. And so when you think about the majority of the assets that are coming into the markets, I think they're long-term investors. And I don't understand why, companies jump through hoops for quarterly sort of ideas in the public markets. And in private equity, there's a lot of disadvantages to, we have an average of a 5-year hold, a lot of disadvantages to illiquidity, but there's some real advantages, right? We don't have to be so concerned with how the wind blows in the market on any given day. There's a lot of advantages to that. And so long-term shareholder value for me is 100% consistent with what we're talking about. And if you want to buy,
I totally agree, Mark. I totally agree. I want to just to be clear, when I talk about shareholder primacy, I'm talking about the economic theory that says the purpose of a business is only to generate profits to its shareholders, and the rest will take care of itself. And I think that the mess we're in some ways demonstrates that doesn't work because the system isn't perfect, right? And there isn't enough proper regulation to prevent bad actors from dumping carbon in the atmosphere, for instance. So, I absolutely am focused on generating best-in-class returns for our shareholders, and I agree with what you're saying, which if I'm understanding you correctly, is ultimately if you focus on long-term value creation and you're responsible to your whole corporate ecosystem, and you build better partnerships with your various stakeholders, your supply chain, your employees, your management team, your banking partners, that's going to be a better business, and that's going to generate more economic value also. So that's really what I was trying to say.
I would argue it's a market failure, but we could go there someday.
Yeah,
okay.
We're getting a little too theoretical. So, okay, so I'm up on some examples of, you want examples of social?
Yeah, and social issues that you're solving through those investments.
Yeah. So I'll give a couple. A great example from our portfolio is a business called Traditional Medicinals, which is the largest organic tea company in the United States, and it's the third largest bagged tea company overall, fastest growing in America. All of its products are organic, fair trade, and medicinal. So sub-brands like Throat Coat is focused on cold relief. They have lactation tea called Mother's Milk, which is the #1 tea sold on Amazon and at Walmart, 20% with food stamps, interestingly. Other sub-brands like Gypsy Cold Care, and they have anyway, so they're all $10 million sub-brands. Wonderful products. It's inexpensive healthcare on some level, so there's benefit to consumers in that manner. But the real impact is really through their system's responsibility. So the business is 45 years old. The founder, going out to visit tea growing communities or ingredient communities, realized that many of these communities were quite unstable. And if they were going to grow a business around these ingredients, they needed to build more stable communities. Upon doing research, he realized actually not just medicinal tea, but the entire global drug trade overall today is still derived 80% from plants and plant-derived extracts. 80% of those are not grown agriculturally, and the vast majority of what remains is picked by hand, largely by women in emerging economies. So 45 years ago, they set up a foundation which is fully funded to invest in sustainable development. Purely self-interested. However, it's now a 45-year tale of amazing impact across 40 different countries globally, ranging from building schools in India to water catchment systems in the Rajasthan desert to dental clinics in Bosnia, and so on, right? Buying bicycles to get kids to school. And that's now built a more resilient supply chain that's targeting these very difficult to find drug quality herbs, which leads to best-in-class products that are efficacious here in the United States. And they extend that kind of systems responsibility and thinking across their corporate ecosystem. You know, they now produce 100% with renewable energy, which avoids meaningful amounts of CO2. You know, they're deeply engaged in their communities here in the United States and California predominantly, where they produce, and so on. Other examples, a bit more briefly, would be, you know, we have a chain of fast casual restaurants that's focused on employee advancement, and you know, so in an industry that has 200% annual turnover, and generally folks working in fast casual restaurants, fast food, you know, don't make a living wage. They pay 100% living wage. They pay full health care benefits, 401k support, free lunch every day, travel vouchers, and 2/3 of their manager level hires are hired from within. And that's led to 3-year average tenure, which creates better employees and lowers the cost of hiring for them. So similarly, we have a business called Urban Remedy, which is now a $50 million, growing 80% a year, plant-based, ready-to-eat meals and cold-pressed juice business that we're in the process of taking national. Most of their impact beyond healthier food is actually through their production. So they've built their production facility near or next to an opportunity zone in Point Richmond, California, and they've created over 300 LMI, or low moderate income jobs in that community. And you know, the company benefits you know, due to regulations that make opportunity zones a tax benefit. So there's a few examples.
Can I jump on that one and just use that as an example to voice one of our challenges, right? Plant-based. When we're doing a lot of thematic research and basically looking at things. It's primarily connected to the climate transition, but it has important overlaps. And one of the things that we identified as something we want to have more exposure to is plant-based foods, right? Alternative proteins, and it was actually quite a lot of excitement around the table for that. And then we start looking into, so how can we get that exposure? And again, you know, across assets, across the world, and so on and so forth. And we decided, you know, this was a while ago, that we're going to table it for the time being, because we couldn't. You know, it was difficult for us to find good exposure. You know, there's company specific, you know, their IPOs and so on, but they tend to be one-offs and so on. It's hard to, as a medium-sized pension fund, to find you know, an attractive slice of the market or portfolio which is not, you know, very high on company specific risks or specific technology or specific region. So I think something that we would be very interested in hearing, you know, again, you know, using this as an example, but I think it cuts across most of the ESG landscape is, you know, one alternative is to wait 5 years until it matures and it becomes, you know, stable. But, you know, that would also be sad to see if you're writing your analysis, you're waiting 5 years and then you get basically lower returns, you're missing out on some. It would be very interesting to see more aggregation already at an early stage. You know, smaller fund managers collaborating, building up platforms where also larger investors can come in at an early stage. And it's not only the scale factor, it's also, you know, by doing that, almost by definition, you're creating a portfolio which diversifies the risks, right? So it's the old fund-to-fund thinking, but it's not, you know, but it could be constructed in a slightly different fashion. I think that would be one way of pushing this agenda much faster and becoming, you know, in making it more institutional mainstream quicker than, I think it will happen inevitably, but it would just make it faster.
I Totally agree with you there. And that's a challenge for us intermediaries, amongst others, to support investor community and emerging fund managers to grow to that scale. So we're getting a lot of questions.
There you go, Mark. Mark, maybe you and I we'll team up. We'll call it New Markets Builders, and we'll raise 500 instead of 250.
There you go.
Collaboration and partnerships, you know, that's the way forward for all of us. We're getting a lot of comments and a lot of questions in the comments. So please, that's fantastic. Keep them coming. We'll try to get to some of those questions. Everyone is eager to hear about measuring impact, but let's just, Marcus, I wanted to ask you if you want to fill in specifically more in detail on if I think you answered the question. So what is it that you're missing, and what would you like to see more of?
Yeah. So no, I mean, I would, you know, I always want to see more of everything, right? But again, you know, I went to one of these impact conferences, and I had so many really great, interesting meetings. You know, very much aligned to the themes that we have identified: resource efficiency, you know, food, agri, smart agri, all these things, right? But almost every single conversation I ended with, "Oh, this is interesting, but your fund is too small," right? And to me, that seems like an inefficiency. It's inefficient for me and for us, but it's also inefficient for all the, you know, great fund managers raising funds, right? Having to, you know, constantly hear that, well, you're doing the right thing, or, you know, we think you may be a little bit too niched in this area. So again, I think by also thinking from an early point about aggregation and so on, it's not necessarily the fund manager, it's not necessarily us, it could be, but also, you know, there are a lot of intermediaries and so on. So that's one thing I'm missing. Another one is, and I'm not even gonna, you know, it's a tricky field to get into, the impact reporting and so on and so forth. At the moment, that's for us, but it's different from other, I know even from other pension funds, that's less of a problem because, again, we don't necessarily report on social impact metrics as is. We link broadly to the SDGs, but we have some, I mean, it's very well, in some asset classes, it's very difficult with materiality and so on and so forth. It's also very time consuming. And I have personally looked into, because I used to work at the World Bank, how IFC does it. And so I think they have a very good approach. But I also know they have 25 PhDs doing the work. So it's not an easy one. And I think and I'm not necessarily asking for one, you know, reporting across the line, that everyone should do the same. But I know it often raises questions, and I don't have the answer. But, you know, for us, you know, at AP4, it's less of a problem. We need to understand it. But if you're using system A or system B or system C, it's less of an issue, as long as we understand it and we think it's credible.
And yeah, that's a completely different topic, you know, which systems to use and why, etc. But even so, Mark and Trip, do you want to address, you know, what guidelines are you using today, if any, and in terms of measuring your impact?
Sure. Go ahead.
Or Mark, or sorry, either or.
Go ahead, Mark.
Thank you. It's obviously a super important criteria for us, or lens, and it's something that I think needs to evolve, like your investment thesis evolves, or a good investment screen. How you learn about impact measurement, I think, is as important. And so, you know, we've been through it, and I've watched the industry evolve. So there's a gears measurement criteria, and we were on the board of the it's part of the B Corp movement in the US, and we were on the board of the Standards for Education and Workforce, helping the organization that coaches everybody on measurement and holds the standard that's supported by people like Prudential and those people. So they came to us and said, you know, help us figure out what it's going to be in your space. And then, whether or not we are going to force our portfolio companies to measure recycling, or what kind of fluorescent bulbs that they use in their office, or are we focus on, and then we've adopted, as a lot of people have recently, the SDG sort of measurements, Sustainable Development Goals from the World Bank, as trying to have a unified approach. Ultimately, as investors, we need to see the key performance indicators at the board level, the financial metrics, be the same impact metrics.
Okay.
And so the most successful investments we've seen are board level performance indicators of the company actually are the same things we're measuring. So like Marcus asked a very good question, right? Are we paid for performance in this dropout recovery company? So engaging the dropouts, finding them, bringing them on, their persistence in our program, their graduation rates, their achievement of the certificate for job training, the placement in the job, the persistence in the job. Those are all the things we got paid on. They're the same financial indicators. Mm-hmm. And so if an LP or somebody in the marketplace says, we need you to have this type of reporting or that type of reporting, we want it to be driven by the portfolio company, of course, as a business metric. Mm-hmm. And we don't want to tell them what impact metrics we're going to require from them. We want to invest in the companies that are showing business operational performance. And then the CEO is amazing. He brought 5 people in from his previous firm, and each one had a compensation structure that was directly motivated by these impact metrics that were the same as the business metrics. That's how this all works. So there's so much binary thinking and duality that I think needs to go away, like whether it's impact or whether it's not, whether it's commercial, whether it's shareholder, like the more we blur those lines, I think the better.
Fantastic.
We view that very similarly, Mark. I'll try to be quick because I think we've only got about 5 minutes. But we also very focused on customized KPIs that are relevant to the individual businesses, and the core of that is tied to the fundamental business model, so that the things that we're doing to grow the business are generating the impact-related metrics. So more sales means more organic, healthy meals and more organic produce supporting that supply chain, or pounds of carbon avoided from the atmosphere, or, LMI jobs created, or whatever it is. And then, I think to the other elements, we try also not to get into the fights over my impact measurement God is better than your impact measurement God. We're in the trenches trying to build companies and be successful. And we want to use the best-in-class tools to report to our LPs, and we're very conscientious about what LPs ask for. We do also integrate with B Labs, and we've been Gears rated, and we use the B Impact Assessment as a fundamental tool, also for impact or ESG measurement at entry, and as a tool to engage with our management teams around their commitment and authenticity as it relates to impact and impact measurement. So we use that, creates a baseline, and then we look to improve their BIA score over time, specifically because we believe ESG factors are a driver of value. So that's an important one for us. And then, as you noted, more recently, we've also integrated with the SDGs, and we report where we're adding value on the SDGs. I'll call out the Impact Alliance classification. It's IMP plus ACT. ICS it's called, which is a great, relatively new tool that helps overlay against the SDGs also what types of impact you're having, whether it's to avoid harm, to benefit stakeholders, to contribute directly to solutions, or to contribute to solutions specifically in undersupplied markets. Not that any one is better or worse. I think there's a spectrum of impact that we need everywhere. Those are slightly different types of impact. And so it becomes a very useful tool, I think, about communicating how your portfolio or your approach overlays against those opportunities.
Fantastic. So I can recommend everyone who's listening in, you can read the sustainability and impact reports on each participant's website. That's a good reading. And we're recording this, and we're running over a little bit, catching up on time that we lost in the beginning. but we're recording it and it'll be sent out to everyone. And so, just to round things up, do you want to say a few closing statements? We've just had a pandemic, or forward-looking. How are we gonna? This is a timely webinar. We said social factors will be even more important going forward, we believe, and it's an opportunity for us. How will we be talking about this in 5 years' time? Short question.
Can we have 50 minutes instead of 5?
I don't know if that would help me. No, I don't know. But let me just say first, thanks, Mark and Trip for interesting comments. And I would also certainly be keen to hear from participants that have both ideas or running funds, but also have ideas how we can again, I'll come back to where I started, how we can make this pushing this quicker than what would be the case before into mainstream, making sure that we also scale things up, and we think how we can use these best in class and very forward-leaning managers, and also to the rest of the industry. So because at the end of the day, it's also I think Trip said it, a lot of their, or maybe all of your strategies are supposed to be outperformed. So at the end of the day, that would from our end, that would be a good thing for the Swedish pensioners. So thanks.
Thank you. Mark?
In some ways this is an optimistic, in some ways a pessimistic statement, but the issues that the impact investment world faces will become more and more relevant. So unfortunately, in the next 5 or 10 years, climate change will become an issue that requires more and more focus and resources. Human capital management, getting people the skills so that they can stay employed, will become more and more of a burning issue as it becomes a people-centered economy. Lifelong learning, the 50 to 100-year-old educational system in the US that we have, which was training people to go into factories, will have to be completely disrupted, and that's going to take a decade or two. Like each one of these things, the healthcare issue, increasing issues of obesity and diabetes, right? It's all going in the wrong direction, which is a wonderful opportunity for the impact world to become more and more relevant and basically overtake any other focus of commercial activity, in my opinion.
Yeah, here. I like that sentiment. And again, I go back to how we think about our firm. Disruption creates opportunity, and these big problems, right? We're sitting at the middle of these sort of multiple intersecting dramas right now, right? A pandemic, a reckoning with racial injustice, an economic crisis here in the US, certainly, a political crisis. And each one of these is causing disruption. And, if I can be the optimist, that creates great opportunity, and the human ingenuity should be able to go attack those challenges and solve them if we can focus on the problems. And to me, that's the greatest economic opportunity of our lifetimes. And that's what we're trying to build with our firm is an investment platform that is institutional grade, that guys like Marcus can invest in, and that can actually go solve the problems that we're facing.
I think it goes to show, like in a global pandemic with 40 million people unemployed and everybody going online for learning, right? Every one of our portfolio companies is very well positioned to thrive in that sort of environment. I mean, we're here to help. And it's been a great mantra across the portfolio, and just being good corporate citizens at a time of crisis. It's going to serve us very well economically.
Yeah, thank you very much. On behalf of my partner Christian and I at Hansa, we're totally dedicated to this area, and we see it as an opportunity as well in the midst of the gloomy forecasts as well. But this is an opportunity to see the opportunities and come together and work to scale them and make them accessible and hopefully faster than we've seen before. Thank you, everyone. Sorry for the technical issues we had. That was we had a lot of people coming in at the same time. Thank you. We want to say thank you to Reuters Events for hosting us, to our great speakers, Marcus and Mark Tripp. We could continue 2 more hours. And thank you for sharing and your insights. And thank you to all of you who's been dialing in today.
Thank you, Jessica.
Thank you, guys.
And I'd just like to, before we go, just apologise for the technical difficulties at the start, but it was clearly worth waiting for, as that was a really great discussion. So thank you to all the panelists for joining in there. And if you want more ESG related content, there's lots more coming up from Reuters Events. We have 2 summits, ESG Investment North America on 13th and 14th of October, ESG Investment Europe on the 2nd and 3rd of November. So 2 days, we get into a lot more detail, over 30 sessions at each event. There are free taster passes available. More information will be sent out after this, but thanks everyone for joining and for holding on and for leading us through the issues. And thank you to our panelists.
Thanks.
Thanks, everyone. Great talking with you.
Bye.
Care.